Hey guys, this second part of the video is when it comes to installment sales. And in this video, I'm going to discuss the installment sales as it applies to flipping. So in my previous video, I covered what it means for an investor to sell a property on an installment sale. Now we're going to talk about flipping. Okay, let's get started. Okay, so if you want to flip property, this is where you get into a different area altogether where you can get yourself in serious tax trouble if you don't know what you're doing when it comes to selling property on an installment sale. I can't tell you how many people who flip property will call me up and say, hey, what can you do for me? I'm stuck in this situation. My CPA just told me I owe the IRS $120,000. And I don't know where that money's coming from because I don't have it. And I've never received it. I've sold these properties and I haven't brought in that much money. Where are they wrong? What can we do? Well, unfortunately for many of those investors, their CPAs are 100% correct. Because when you flip property, you're what is considered a dealer. Now, I've got other videos on this, but just to recap what that means, okay? A dealer is someone. It could be an entity or an individual, doesn't matter. I prefer to you do this through an entity so you're not treated as a dealer individually. But it is someone who buys property, real estate, with the intention to sell. That is, you buy it and you treat it as inventory. So people who flip, rehab property, you're going to fall within that dealer category. Now, what happens a lot of times with these individuals who are dealers, they don't realize what are some of the negative aspects of being a dealer. Well, just to refresh your memory, there's no 1031 exchange treatment available to dealers because the homes that you're flipping are considered to be inventory. All income is active income. So everything that you bring in from the sale of your property is going to be considered active to you. It's not passive like it is if you're an investor. It's going to be active. The other part about being a dealer is that you have no depreciation. So if you want to depreciate your property, engage in a cost seg on that real estate, it's not going to happen. You don't qualify for that because you can't depreciate inventory. Inventory is held in the ordinary course of your business for resale. Now here's the other aspect about being a dealer that screws people up who are selling property on an installment sale. You do not qualify for installment sales. Okay, boom, boom, right there. You don't qualify. So what does that mean then if I don't qualify for an installment sale? It's because individual investors that flip properties, because they do not understand the context of this, how it applies to them, this is where they get into trouble. So what does this mean then? Well, if I'm a dealer in real estate, and let's assume that you've set up a business entity here, you've got a corporation set up or an LLC taxed as a corp. That's typically what I recommend if you look at the other videos. If you're going to be a dealer and you're going to flip property, you should have an entity that's set up to be taxed. I prefer C Corp. Some people use S corporations, but nevertheless, this is going to be a corp here. An LLC or a traditional corp, an entity treated as a corp for tax purposes. Now, this year, let's assume that I flipped 7 properties on an installment sale. So I had 7 properties sold on installment sales, and the total value of those properties that I received, we add up all the sales contracts of these 7 properties. Let's just say it's $1 million. It's $1 million. Now, my basis in all of those properties, that is the money that I spent, remember, to buy the property and the money that I put into the property. So my tax basis on all of these properties is $750,000, $750K. So what is my expected gain out of these deals, the sale of these 7 properties? Well, the expected gain is the difference between your tax basis and what the sale price is. So it's going to be $250,000 is going to be my expected gain when from all the sales of these properties. Now, if you sold them outright, you get the $250,000, right into your corporation. Your corporation would have $250K profit. We get that. I brought in the $250, so I pay tax on it. But on an installment sale, it's different, right? Because even though you sold 7 properties, and the total sale price of all those properties is $1 million to those 7 different homeowners, you didn't receive that. What did you receive? Well, you received a down payment. So let's assume that on each of these properties, we took down $10,000. So I received $70,000, $10,000 on each property. Now, I received payments. Let's say that all properties were sold in January, at the beginning of the year, just to make it simple. And each person paid me $1,000 a month. All right, so that's each house is bringing in $12,000 on an annual basis. So that's $84,000 I brought in payments, $84K. So let's do the math here. $154,000 is how much I received this year from those buyers. So if you're looking at this, how much is your income to the corporation? Well, a lot of people say, all right, well, it's $154,000 is what my income is. No, not. It's not $154,000, okay? Your income from the sale of these properties that you have to pay tax on is the $250,000. Even though you only received $154,000 of that $1 million, you have to pay taxes on the full $250,000. That is the problem for people who flip on installment sales. Because you do not qualify for an installment sale treatment as a dealer, all of that income is taxable in the year of the sale, despite the fact you're not receiving the money. You still have to pay taxes on it. This is how people get into trouble. And in my example, I assumed all properties were sold in January. And many times, you know the way it's going to work. You sell a property in February, April, June, a couple in October, December, right? I mean, that's the worst part. You sell them in December and you bring in $10,000 in that December sale, and there's $50,000 in gain on the sale of that property. You're going to take that $10,000 you brought in, you're going to pay it right out to the federal government in taxes. So the issue we run into when we're selling property on installment sales as dealers is that you pay tax on all of your gain in the year of sale, despite the fact you didn't receive the money. In my last video, you heard me talk about investors, where you pay the income taxes over time as you bring in the money. Not as dealers. You pay taxes when you sell the property. So what do you want to look at then if you're doing this? Or what are some strategies around this? Can you get out of it? No, you can't, unfortunately, when you're flipping property. So why do I like to use a C Corp for people who flip, especially in installment sales? Because a C Corp's taxed at a flat 21%. So if you're paying tax on $250,000 at 21%, I mean, it's a lot better than if it was taxed down to you and let's say you're in a 30% tax bracket, right? You're now saving 9% in taxes by having that money, which kind of looks like phantom income, be taxed to the corp. Now, by the way, when you receive all those funds in the future, okay, you're not going to be taxed on it later on since you already pay tax on it up front. The only thing you're going to pay tax on an annual basis beyond this would be the interest portion of that income as it comes in. So you pay taxes, you get the interest income coming in. But the gains, you've already paid the tax on that. So basically you stepped your basis up to that $1 million in my example. So what are some things to think about if you're flipping property on an installment sale? Number one, I would try to avoid sales in, I would say October through December if possible. Try to restructure those more as a lease option with those tenants. So you do a 3-year lease option to buy in January. Work some type of creative arrangement with them to push that income into next year. Because when you pay the tax or when you sell the property in November and December, if you're a calendar year taxpayer, you're paying tax on all that income and you're bringing in very little. Whereas if you sold it in January, now you have 12 months of at least receiving payments from your buyer to help cover the taxes associated with the gains that come in from that installment sale that you're forced to pay tax on in year one. So that's one thing I would look at. Another thing I would look at with the C Corp is choose a fiscal year end. Okay, so rather than be on a calendar year end with a C corporation, you can set your tax year up so it ends in March or June or September instead. Now, why would I look at fiscal year ends? Let's assume that in your business, you determine when you map it out and you say, all right, so most of my property sales take place within this 7-month period maybe, or 8-month period. Well, then knowing that, I would try to position my tax year end so I can capture as much of that income before my tax year is up. So if most of my sales took place between, let's say they took place between October and March, all right? Well, if I knew they took place, most of the sales took place between October and March, October and June, then I'm going to set up my C Corp with a September year end. So my year end is right before the Corp. So then I'll get more payments into my company through the buyers before my tax year is up and I have to pay taxes. So that's always a good strategy to consider. Another thing to think about is always file extensions. Again, you can have more money coming in to help cover those tax liabilities. Now, here's a strategy that I want to share with you that is a creative, a little bit aggressive, that you may want to consider as well. So, rather than, do all of this stuff, but the other thing you can look at is setting up a separate company over here. Set up this company. Typically, this one's going to be an LLC, and I'm going to tax it as an S Corp. So I'm going to have a C Corp here, and I'm going to have an S Corp here. And I'm going to make this my factoring company. Okay, so if you're not sure, you're not familiar with factoring, what factoring is that you have an installment sale, you have a note, somebody owes you money, right? And that's what we have here when you sell your properties to an individual homeowner, they owe you money. And you take that note and you sell it to another company. Company will come up to you and say, listen, I want to buy your receivables from you. And so in order to sell them a receivable, what you're selling them is that income stream. So if you wrote these notes up, 5-year balloon, and they're at 5%, then 5 years, okay, well actually it'd be higher than that. Let's say they're at 7% interest. Then a company would come to you and say, what is the total value of those payments? What is the income coming in off of that? And it's determined to be $30,000 of income they're going to make. So they'll tell you, I'll tell you what, I'll buy this deal from you for that $30K, I'll give you $10K, $10,000. So you're going to forego collecting that extra $20. You're going to take $10,000 profit up front plus your original basis in the note. So they'll give you what the basis that's owed, the principal, plus $10K of the interest. They'll pay you that. And then they're going to take the $20K and they're going to collect on that and they're going to get paid on that. Why would you do such a thing? Well, because now you get your money up front. You can go out and do more deals with those funds. That's why you're doing it. So you could look to sell your existing notes to a note buyer. And there's lots of people out there that buy notes. You could look at doing that. Or you could do it to your own company. You could set up your own note buying company where you agree to buy your own notes. Now, depending on the value of the properties, this may or may not work for you. But for some of my clients, what we look at doing is that they're selling the installment sales out of their C Corp. And then we have this factoring company over here that comes in and it buys the notes. So it ends up owning the notes. Now, the reason we're buying the notes is because as follows. Remember, if I sold a property on an installment sale as a dealer, sold this property, and my expected gain in that property is $50K, and I'm only bringing in $10,000, well, I don't have enough money, or I barely have enough money to cover my taxes. So instead of having it taxed to me all in year one at $50,000, I'm going to sell my note to a factoring company that I set up, and that factoring company is going to pay me $10K. So now, what do I have to recognize in year one? Not 50, but 10. What is my tax liability on $10,000 to the corp? $2K. I brought in $10K on down payment. I got enough to cover my taxes plus $8K left over. Now, what happens to the other $40,000 here that's still coming in from the note? Well, that's going to come into the S corporation that's a factoring company. it's going to generate that money. It's going to pay taxes on it as it comes in. You see how we just changed it now? We went from a situation where it's immediately taxable to deferring the taxes by using a separate company. Now, in order for this to work, you have to have an arm's length transaction here. It has to be commercially reasonable to do all of this. And the reason why you're setting it up is because your other business is providing the much needed cash flow you need over here, because the more money you can pull back out of this deal, that means you can go out there and buy more property. So that's why you're selling the note. It's not to minimize or avoid taxes, okay? You're doing it because you need the cash flow. So as a flipper, I give you a couple different ideas now. If you're gonna buy and sell real estate and you're gonna use the installment sale treatment as a dealer in real estate, then look at using a C corporation. Look at changing your fiscal year end up, okay? Look at when you're selling the properties to try to get more money up front. Look at trying to defer the sales through a lease option. And then if those strategies don't work out for you, also consider setting up a factoring company over here where you can help fund your deals through the factoring company so that you cut the income down here and you spread out the income recognition over time. Guys, it's all about planning, sitting down with someone like Anderson, my firm, and going through your scenarios and determining what's going to work the best for you. Many times people go out there and they just set up the entities, they start doing the business, and they don't think through the implications of the activity that they're engaging in until the end of the year when the CPA prepares their return. They say, hey, you owe this much in tax. And you start looking around going, where's the money to pay the tax? All right, hope you got a lot out of this. I know I packed a lot into these two videos, but it's an issue that has been coming up more and more with individuals. I've been getting a lot of comments and questions about it. So I wanted to get that information out there and at the beginning of the year here so you can kick it off on the right footing. All right, take care. Thanks for watching.